People love to believe they're smarter than basic math, especially when it comes to money they don't actually have. I've watched thousands of people, bright people, educated people, successful people, ruin their financial lives with debt they thought they could manage. They call it leverage. I call it legalized self-delusion. And if you're sitting there right now debating whether to invest or pay off debt first, you're already standing on the wrong side of the fence. This is State Log, where we break down what actually works versus what sounds clever in theory. Today we're answering the question that everyone gets wrong. Should you invest while carrying debt, or clear the debt first? The financial advice industrial complex wants you to believe this is complicated. It isn't. Here's the logic you've probably heard, maybe you even believe it. My debt is at 5% interest. The stock market returns 10% on average, so I should invest while making minimum payments. I'm earning that 5% spread. That's just math. Sounds rational, right? Sounds like something a sophisticated investor would say. It's also how people go broke. You see, this argument rests on three assumptions, and all three are wrong. First assumption, that 10% is guaranteed. No, it isn't. Markets crash 40% sometimes, and they crash exactly when you can least afford it, when you've just lost your job, when rates spike, when everything goes wrong at once. Your debt doesn't crash with it. Your debt collects, always, with perfect discipline. Second assumption, you'll stay rational during volatility. You won't. When you're leveraged and the market drops 30%, you don't think clearly. You panic. You sell low. You make desperate decisions because you have to, not because you want to. Meanwhile, the debt-free investor, they're buying. They can wait. They can think. Third assumption, you're measuring the right cost. The interest rate on your debt isn't the full cost. The real cost is the distraction. It's the mental space that debt occupies in your brain. It's every decision you make through the lens of, can I afford this payment? Instead of, is this the right move? Let me show you the math everyone ignores. If you owe $10,000 at 15% interest, that's $1,500 a year guaranteed loss. You can't diversify it away. You can't hedge it. It's certain. Now tell me where you'll find a guaranteed 15% return in the stock market without taking risk. You won't. Not legally anyway. That's the brutal beauty of debt. It's certainty working against you. And certainty is the most dangerous thing in finance when it compounds in the wrong direction. People ask me, but what if my debt is at 3% and I can earn 7%? Here's what I tell them. You're earning 3% and risking 100%. Because debt doesn't just change your returns, it changes how you think. When you owe money, your world shrinks. Every decision becomes defensive. You stop thinking about opportunity and start thinking about survival. I've seen people with great judgment make cowardly decisions because their loans dictated their behavior. They sold assets they believed in because they needed liquidity. They passed on opportunities because they couldn't take on more risk. They stayed in jobs they hated because they needed the steady paycheck. That's not wealth. That's servitude with a brokerage account. Here's the pattern I've seen play out hundreds of times. Someone starts investing while carrying debt. For a while, it works. The numbers look good. Their confidence swells. They tell themselves they've mastered risk. Then the market sneezes. Maybe interest rates tick up. Maybe one investment goes bad. Maybe they lose their job. And suddenly everything they built starts collapsing. Not because they weren't smart, but because they had no margin for error. Debt removes your margin for error. It converts a temporary setback into permanent loss. The people who survive market crashes aren't the ones with the biggest portfolios. They're the ones with the smallest obligations. Let me tell you what debt really steals from you. It doesn't just take your money, it steals your time. And time is the raw material of compounding. You see, compounding only works when you give it decades to do its magic. Debt destroys that timeline. It forces you to focus on the next payment instead of the next decade. When you're debt-free, you can wait for the right opportunity. When you're leveraged, you have to swing at every ball that comes your way. That's the difference between discipline and desperation. I've watched people spend entire careers compounding wealth for the bank instead of themselves. They earn, they pay interest. They earn more, they pay more interest. The meter never stops running. And here's the part that kills me. These are often the same people obsessing over whether they should own 5% more Apple or 3% less Tesla. Meanwhile, their credit card is quietly compounding faster than either of those companies ever will. That's not investing. That's intellectual theater. It looks smart, but it's dumb as hell. You don't fix a leaking boat by buying a faster engine. You fix the hole first. Every dollar you owe is a dollar that can't compound for you. And every year you spend paying down old mistakes is a year stolen from your future freedom. If you start investing at 25 and stay debt-free, time becomes your ally. If you start investing at 35, buried under loans, time becomes your enemy. Same person, different outcome, all because of leverage. So here's my answer, and it's not complicated. Pay off the debt, always. Then invest from a position of strength, not weakness. The best risk-free return you'll ever find is eliminating debt. It's boring. Yes, but staying solvent is boring too. And boredom is underrated until excitement sends you a margin call. People hate hearing this because they hate the slow path. They can't stand the idea of spending 5 years cleaning up their finances before investing. So, they jump ahead. They tell themselves they'll manage the risk. But reality doesn't care about your impatience. If you skip the boring steps, you don't accelerate, you detonate. When you're debt-free, something extraordinary happens. You start making decisions for the right reasons, not the pressured ones. You can say no, you can wait. You can ignore the crowd because you're not desperate. Independence is like oxygen. You don't notice it until it's gone. The person without debt can wait for opportunity. The person with debt has to beg for one. And the market doesn't reward beggars. Look, you can't predict markets. You can't control recessions, inflation, or interest rates. But you can control whether you owe someone money. That's real power. So if you're still wondering whether to invest or pay off debt, here's what I want you to understand. This isn't just a financial decision. It's a philosophical one. It's a choice about how you want to live. Do you want to spend your life managing obligations or building opportunities? Do you want to react to the world or respond to it? Do you want to be owned or free? Pay off the debt. Stay debt-free. Then invest patiently. Let compounding do what it does best. Reward the patient and punish the reckless. You'll look slow for a decade. Then one day you'll look brilliant, and people will call it luck. But it won't be luck. It'll be math, patience, and the absence of stupidity. That's not just good advice. That's the only advice that matters. Because wealth without freedom is just poverty with better furniture. And nobody, not even the cleverest investor, alive can compound their way out of that truth. If this changed how you think about money, hit subscribe. We're building a library of uncomfortable truths here at Statelog. Next week, why diversification is overrated and what actually protects your money. See you then.